The last one here is the exchange rate effect. So this has to do with net exports. So savers now are looking at shifting their assets into less liquid accounts. The interest rate, though, is dropping, not yielding them a high rate of return on their savings. They're not getting a very high interest rate because interest rate is dropping due to the increase in supply into the loanable funds market. Now, savers are always going to seek the highest rate of return on their investment, right? So you want to find an account that's going to pay you the highest interest rate, or invest in a stock that's going to yield a higher rate of return. As the domestic interest rates drop, money will flow out of the country seeking higher rates of return abroad. So we have an increase in the supply of domestic currency on the foreign exchange market. So we're tying in exchange rates here. We've got people trying to put their money into higher rate of return accounts abroad because the domestic interest rate is falling. And to do that, they've got to change currency. So say this is the US, we've got more dollars on the international market available to change. That's going to lead the currency to depreciate, right? It's going to make the currency worth less because the supply of the currency on the foreign exchange markets is higher. So we have currency depreciation, and as the currency decreases in value, then what happens to our incentives to import and export? When, say, the US dollar is not worth very much, it's going to be really expensive for people in the US to buy things that were purchased abroad. So imports will decrease. Likewise, when the US dollar is not worth very much, it's cheaper for people who live in Europe to buy things produced in the US. And so exports will increase. And both of these factors, the decrease in imports and the increase in exports, lead to an increase in net exports, because remember, net exports is equal to exports minus imports. So that leads to an increase in net exports again in the short run. These are the three reasons why aggregate demand is downward sloping.